financial correlation network, and it's Kimmo Soramäki from. So thank you. Please begin.
All right, thanks a lot, and thanks a lot for inviting me here. So yes, I'm the founder and CEO of a company called Financial Network Analytics. We're based in London, a sort of startup company. It's the company's developing software, and the software is based on research I've been doing for quite a while around financial networks. So what we've been doing today, or looking here, is looking at stress testing financial networks. This is really something that started after the financial crisis. Actually, sort of where my sort of introduction to networks came about 12 years ago. I was the New York Fed's research department, and we started looking at how the banks are connected in the US financial system through payments that they make with each other. And this was for the purpose of understanding how the terrorist attacks of 9/11 changed this network of banks, as some banks got wiped out completely, and there were a lot of liquidity problems, sort of solvency problems, and we did research trying to understand how that network reacted to that, and how then it bounced back actually very quickly in the next couple of weeks. Then the financial crisis came, and all of this research became much more relevant because everyone understood that we need to understand the interconnections. When Lehman Brothers was failing, no one knew like who is exposed to Lehman Brothers, what is it connected to, what are the connections beyond Lehman Brothers, so should we fail it, should we bail it out, or should we not? So these are the type of decisions that the regulators were making quite blind at that point, maybe making some phone calls based on qualitative information. There was no data available on these interconnections on a quick basis. Actually, it took, I think, a couple of months to figure out all those exposures, and like there are cases where there's some bankruptcy in the 70s, and the jurisdictions only sort of figured out who was owing what in sort of late 2010 or something like that. So these cases can take very long. So what we find out in this research was that so the system, the US has about 8,000 banks. All of them participate directly in the FedWire system, but 66 of these are in this core, and they comprise 75% of the total value. And of this, we see 25 banks in the center, and you can immediately see, so each node is a bank here, and links are sort of the value of payments that they transacted in a particular day. These are very similar from one day to the next, and you can immediately see that there are maybe 4 or 5 banks that could be considered systemically important. So this picture was then used in congressional hearings in the US as an example. Okay, these are the type of maps we should have about the financial system for future crises. And there's been a lot of work in the last years to actually operationalize and get this data. And now regulators have access to individual trade data across a large number of markets. So this was the original idea for me setting up the company, to develop software and system and methodologies and research. How do we identify systemically important banks? How do we develop systems for ongoing monitoring of complex financial systems? And what has also changed recently is that risk management has changed tremendously in banks. Before the financial crisis, it was based a lot on value at risk and Monte Carlo simulation. But now, of course, those are still being used, but that especially the sort of regulatory approach has moved from statistical risk analysis, looking at distributions, into stress testing, sort of doing what-if scenarios. Are you able to cope with certain scenarios? And that is very different sort of approach, because a lot of these we've had these bar exceptions, like 6 standard deviation events that are supposed to be happening 1 in a trillion years, and we had them happen like consequently on several days. So clearly the sort of those models were not useful at that point of time anymore. So what all these regulators are now doing, the Fed has something called CCAR, Comprehensive Capital Adequacy Review, or something like that. The ECB is doing for stress testing, the Bank of England, the European Banking Authority, Hong Kong Monetary Authority. All the central banks are doing stress testing of the financial system. And if you think of like these networks, I always think of two different types of networks. I think of transaction networks, where we're looking at payments or trades or purchases or exposures or supply or flows, something we can measure directly. So we have a clear idea what the nodes are, then we can measure, okay, what is the link? Did they do a trade? Was there a payment? Was there a purchase? And so forth. And those are transaction-based networks in my world. And then we have similarity-based networks where we are inducing, we just have time series data, and we are inducing that there must be some kind of a relationship between these two because there's a correlation or some other statistical measure, like maybe there's a partial correlation or Granger causality or transfer entropy. And there's a lot of research now going on looking at, okay, how do we create networks from different statistical models, and what we should consider, when should we build a link between two things when we have time series data about them. So the rest of the talk is going to be more on the similarity-based networks, these correlation networks. In sort of correlation, I just say that any type of sort of dependency, however that's measured. Is what we will actually find out, like in the last years when talking with a lot of people around these networks. The networks are really everywhere. So we found these in like applicable in money laundering, in fraud, where networks or graphs can provide features for the models, like in the previous talk. In asset management, in risk management, in regulation and systemic risk analysis, and so forth. And also, what has happened is the markets, the financial markets, a lot of the data in finance about the financial markets, they become more correlated, more interdependent. So all these links have gotten stronger, and therefore all this network analysis has become more relevant for looking at financial markets. So what we're going to do is look at correlation networks. These are going to be on financial time series, but the methodologies are pretty much like you can just interchange the time series to Internet of Things, or talking with I think with GE about monitoring large diesel engines from the sort of sensory data. So you can use these technologies, these methodologies everywhere. So the problem we have here is that we have a large correlation matrix. In finance, actually, most of the correlation analysis that is done by real people is looking at correlation matrices of 3 times 3, because that's sort of the amount of data that you can conveniently consume by yourself. But what we are looking here is correlation matrices that can be relatively large, and they move in time. So there's a time aspect always. A lot of network analysis looks at a single network. It doesn't look at how that network evolves over time. So what we're going to do is just first starting to visualize that data, doing these types of like minimum spanning tree visualizations, and then see, okay, what can we get out of them. So how we start is, okay, we have a matrix, and any matrix you can think of as a network. You just instead of like putting cells in the matrix, you have nodes and you have links. So we start by putting all the nodes here, and the data we have here is they are exchange traded funds, so they are financial assets, and we look at the prices, or actually the returns, correlations of the returns of these assets. So we have things like Germany; those are the equity markets there. We have government bonds. We have energy materials. Lots of different assets representing different sectors of sort of like different types of financial assets. There's like a cross-asset view, a global map, if you can think of it. So then we just put the links, the black links if the correlation is positive, and red links if it's negative. So this doesn't really actually give us anything, this picture. But we'll start like working from this and see sort of what we get as an end result then. So the first thing you could do is that not all correlations, not everything is correlated with everything. So not all correlations are statistically significantly different from 0. So we could drop those. We could also start doing some statistical tests there, sort of correcting for multiple correction with Bonferroni or false discovery rate, and then just drop these links out. So there's no correlation, so we don't put a link there. There's no statistically significant correlation. So we got rid of a few of them. So this doesn't help us a lot either. So then we can start, okay, maybe another layout. So we put all the circles on all the nodes in the circle. Maybe some other layout would give us a better result. So we try now like force-directed network layout. So the force-directed works so that there's a force that pulls things together. The stronger the correlation, the stronger the pull. And then there's a push if there's if they are not connected, so they get pushed away. So then we start seeing there's a strong cluster of correlated things at the bottom and less correlated things at the top, like Swiss franc, utilities, silver. But still, this is not giving us a lot of information. So we need to filter information out. So what we do here is then a very simple filtering mechanism. We identify the minimum spanning tree or the maximum spanning tree, however we find the problem. So we looked at, okay, how would you connect these nodes with so that the total correlations are maximized, for example. So we will only keeping the sort of n-1 links where n is the number of the nodes. You can think of it as we have cities and we want to connect all these cities with roads with the minimum amount of asphalt. So how would we connect those? And those would be the connections. And of course, this layout doesn't give us a lot of information about what is important there. But we can use another layout which was actually developed for displaying phylogenetic trees, sort of like genetic data. And here we map the link length with the magnitude of the correlation. So the longer the link, the weaker things are correlated, and the stronger the link, the more correlated they are. So now we start seeing some structure here already. Actually, we get very nicely a clustering structure here. We notice that emerging markets, for example, cluster together. There's a lot of equity markets, European equity markets, US equity markets in the center. They are driving the markets. We see bonds here clustered together. They are negatively correlated with the equities, which sort of makes sense as well. And then we have currencies here and precious metals here. And Japanese yen acts as a precious metal because it's usually the same way as gold. It's a flight to safety asset. So this starts making sense. We still have a lot of links there, but we start to get that correlation structure. So actually what we can do next is just drop all those non-minimum spanning tree links. And because we're using the correlations as the tree or the network to show the correlations, we have a little bit more freedom to show other data, as for example node size or the node color. So what we do here is we color the nodes red if the return on that particular day that we are looking at was negative, and we put it as green if it was positive. And then we can sort of see that here the equity markets or the emerging market had very negative returns here. There was a flight to safety, Japanese yen, gold going up, the same with these bonds here and the VIX futures, which measures volatility, so was going up as well. So this is our map of a particular day, and this particular day is actually the Friday 24th of June, the Brexit day, when all the markets were going strongly down. There was a flight to safety, and the only things that were actually not affected so much were in this little cluster here, materials and utilities, which normally are also sort of somewhat correlated, but they were detached from the rest of the markets, which were quite in a shock on that particular day. Okay, so I always think of this first step as like doing financial cartography. So we developed some coordinate system, the same way as so this is the first map of the world by Eratosthenes. He actually created this map from the big data of that time. He was at the Alexandria University and he was reading travel reports. So he never traveled to anywhere. He did this map from the travel report data that he had available in the library, measuring how distances, how camels, what kind of distances they could have made on those days that he read in the reports. So we have a coordinate system. He developed the latitude and longitude system. We use the layout algorithm for that. There's some system for visual encoding of the map data, the node sizes. He uses like maybe some reverse, some cities there. And dimensional reduction and filtering. For us, it was the minimum spanning tree. Here, it's like a map is different from a satellite pictures, that it actually takes a lot of information out, so that actually it highlights the information that is important. Okay, so let's take a look at a couple of maps. So the first map is about US housing. So this is, I'm actually going to go to the interactive ones. So the first map is about US housing. So the nodes we have here, they are US states, and this is about the house prices in those states, how they are correlated. And for the rest, it's pretty much reading like the previous map. So we are at year 2000. We have data from 96 to 2016 here. We are at year 2000. This was the time when all the asset-backed securities were created, with the assumption that the correlations are not very high between the states. So if we actually go to the focus views, we see sort of the correlations of Ohio, we see that they are in the range of 0.6 at strongest and yeah, not significant at the weakest, and Ohio is in the center of the network, so anything in the periphery will have like lower correlation. So the assumptions were correct. Everything was going nicely up. There's not much differences in the node sizes. Everything goes nicely up and is uncorrelated. Very good assumptions about when you create these securities. Here we actually map the number of outlier activity. Outliers are movements beyond 95 percentile here. So we see actually the bubble here, and we see the crisis, and we see the recent sort of small bubble. But we also see that there are no outlier activity before we go to 2003. This is when the bubble starts. And we see sort of in this correlation cluster the bubble starting to emerge. So we had like large positive movements in California, in Florida, and so forth. In Nevada, states that we know that had sort of the worst property bubble. We can go to the peak of the bubble. We see that the bubble moves in the center of the network. There are some very large movements, like Nevada is going up 12% in 1 quarter. So it was really easy back then to do a lot of money with flipping houses, buy something, renovate it cheap, and then sell it immediately. We can measure a few things here. So we're measuring here something systematic risk. So this is the first principal component, the eigenvector value, how much it explains from the variation. So we see that the largest factor in this system explains 34% of the variation during the crisis, and actually went during the bubble, and actually went down a little bit during the bubble period. The other thing we're going to be monitoring is the tree length. That's just like summing up those links together. So the shorter the tree, the stronger the correlations, and the longer the tree, the weaker the correlations. So we see that the tree had started already pretty much since 2000, started to go down. So the correlation started getting stronger as we went into this bubble here. All right, so let's go then speed track to 2007. This is where we see the first negative outlier. It's in Florida. And we also see that the systematic risk, how much the largest factor explains, has started to rapidly grow here. So these are the early warning signs for us. Correlations are getting stronger. The system is being governed by a single factor alone. It's getting stronger way before the actual prices started to move down. So this is a good. And also, if you think about it, you only needed to know for these asset-backed securities, which the assumption was that the correlations are not existing. Like you know that okay, those assumptions are eroding way before the crisis hit already. So then we can start moving about. We see that in this cluster here, we start negative outlier. It starts to spread around in that cluster. Things are getting stronger there. We get new sort of pockets of crisis, and the existing ones have spread around, and then start to spread also within those new correlation clusters, until we get to the peak of the crisis here, where again it has moved into the center of the network. And we can see that the systematic risk has now increased to almost 60%, and we've had pretty much every quarter is a new correlation high, so the system is getting more and more correlated. So this was the double dip here, and then slowly we start in 2012, things start moving up again. North Dakota, it's a fracking state, so that's where things started to move up, and then there was this smallish sort of mini bubble that we had lately, which seems to be now fading out. Interesting thing is that the tree length has continued to get stronger, and like the correlations have continued to get stronger and stronger, and now 71% of this system is explained by the single largest factor. So people, when I show this pretty much to everyone, they think that we had the pre-bubbles period, we had the bubble, we had the crisis, and now we are somewhere in the pre-bubble period. Sort of things are similar like back then, but the system is completely different. If we keep the size of this network the same, you'll sort of visually see how this is where we started. This is where the bubble was, so things have gotten a little bit more strongly correlated. This is what everyone knew. In the crisis, all the correlations went to 1. So everything got more correlated, but actually it was not during the crisis. If you see, it was just a gradual move, like over 1 quarter after the other, that things got more correlated. And this is where we are now. So there's a huge amount of systemic risk in the housing market still, because there's no diversification there. But this is across every market that we observe, is that the correlations have gotten stronger and stronger, and that's why it's very difficult now to do diversification strategies. So you need new techniques in order to find diversification in the markets. All right. So the second example I wanted to give was is around another example. So this is exactly the same data as we had in the slides, the example. So what I wanted to show here is so the first thing I always think of this like Google Maps. So the first thing is to create the map like we did in the previous example. Then we put you on the map. Google actually brought that facility when we got these mobile phones, that you could see actually where you are on the map as the dot. And then it gives you directions. So it tells you, okay, how do I get from here to there? Actually, when I came here this morning, I plugged it in, and it found me the shortest route through John's College, John's College, yeah, which I probably wouldn't have found myself otherwise, because it said visitors not accepted today. Anyhow, so this is the markets as we see today, or Monday actually. This is the close prices of yesterday. So we see that there was some negative outliers in the commodities markets, but the rest of the markets were doing relatively silent, some upward movements in utilities. We see our portfolios here. So this is me on the map. I have two portfolios, an aggressive portfolio and a balanced portfolio here. And I see that my portfolios are very much driven by the markets because they are in the center of the network. And they're also very similar, so I've done a bad job at diversifying them. And I can look at what these portfolios consist of. And I have S&P 500 bonds and global stocks. And I see that actually they're also driven a lot by emerging markets. So I have an exposure to emerging markets, even though I have nothing in there. But what I could do next is show the how to get some direction. So I might be worried about something. For example, that let me find this China here. So I might be worried that there's something happening with the Chinese markets. So I can add it to a stress test here. And actually the models here are this is a very simple linear regression models, but there's quite a bit of research now, like developing new models based on networks. So what I do here is give China a shock and say that what would happen to the markets if there was a large downward movement in China today. So based on correlation structure that we observed yesterday, and this linear regression model, I would see that most of the markets that are in the center would go down, and things like gold. And actually, I wouldn't see like a large flight to safety. Pretty much everything just going down. The more closer you are in the network to China, the more down you would go. But now I could say that, well, the correlation structure that experienced yesterday wasn't the relevant one. Maybe I should find some other correlation structure. For example, let's use whenever there is a shock, like the correlations the dependencies tend to be more strong than what they were observed under calm times. So I could look for a date where the correlations were very strong. So I could go to my tree length here and see that, okay, the tree length varied during this threshold in the last year. And there was one date, which actually happens to be the Brexit date, when the correlations were strongest. So I could use that as my correlation structure to do this stress test. And quite often, actually, in practice, these correlations are not used as a variable in stress testing. Which you use as a variable the scenario, the things you shock, but you don't think about the correlation structure. You just say, okay, just use any correlation structure, for example, that was observed using 20 years of data. But these correlations change a lot, and it depends on the business cycle. It depends on the market movements, which things are correlated with which, and which is something that isn't considered a lot today. So what I'm trying to sort of maybe advocate here is that the correlation structure matters quite a bit. So for example, we could do the same stress test on the Brexit day, and we see the stronger impact on everything here, and we see also large positive movements into flight to safety, like we actually observed on the Brexit day as well. Or I could go to find like a less correlated structure, something here in November, when China wasn't so central in the network, and we see that the impact would be mostly contained to the emerging markets here with that correlation structure. All right. So then what we can also do, we can start like editing the correlation structure, saying that China, for example, should be more correlated with the US dollar than it is currently, and we could sort of like edit that structure, and what happens in the background is it keeps it positive, semi-definite, in order to sort of make this correlation structure a malleable thing that you can use as a variable in the stress test. At the end, like I always think, quite often people try to measure the correct correlations with real data, but at the end it's always an objective part of the scenario. What do you think would be the dependencies if these things would happen? And that's something that I think should be done a little bit more than is currently. All right. So I think that's pretty much what I wanted to say. Just sum up. Yeah, so visual methods based on networks allow us to understand correlation structure at a much larger scale than often done before. Community developed correlation scenarios based on historical structures, and then create new correlation structures that we can then use in this modeling, this what-if scenario modeling. I call it stress testing, but actually it's just what-if scenario modeling. And if you're interested in more of these financial networks, we organize a conference here in Cambridge every September. So last one we had a couple of months ago. I also edit the Journal of Network Theory in Finance, and we have a new book out called Network Theory and Financial Risk. I think if you just put Network Theory Finance in Google, you'll find most of these things. They have sort of like, I don't know, different combinations of the same words. Thank you very much.
Do you have any questions?
Thank you very much. When you're estimating the correlation networks for a particular day, are you just using the prices and the returns from that day, or are you using it over a longer period? So do previous correlation networks influence the next one?
Yeah. So in this example, I was using this called risk metrics methodologies. So I'm using the data up to that day and an exponential decay for the volatility. So the further you get back, the less the things matter.
Given that futures traders can make money, markets go up and down, and every futures trader in London would love to know that there's another 4 Brexit somewhere in the next 2 months. The value of the data, is it primarily in pursuit of adherence to compliance, or is it a Pandora's box that if a futures trader got their hands on that, they can predict the chaos in which to make money?
So we have clients who use this for like risk management, for like identifying emerging risks, like the first example about the housing markets. Like that's something that you see sort of, it's a train wreck, like slow movement train wreck happening. And others who use this for alpha, sort of to generate abnormal returns. Mostly using like different strategies around, for example, investing in the core versus investing in the periphery. There's some research that investing in the core gives you returns because you're taking in systemic risk, because things move more in the core, and in the periphery gives you diversification. Or pairs trading strategies, like looking at correlated pairs, and then the system allows you to find them easily and monitor them, that the correlations still stay the same when things change in the markets. We're also talking with a number of central banks to use this actually to create these are sort of top-down. There are 2 types of stress tests: the bottom-up stress test and the top-down ones. So to develop the scenarios for the top-down stress tests, because I think networks give you 2 things here. One is the visualization, so you can actually like communicate very complex topics very efficiently. And then the second one is there's quite a bit of research in improving the like what-if modeling using the network approach rather than using linear models or lasso models. So.
Yeah, if you take the inverse correlation matrix, the influence matrix, then that'll give you the conditional independent structure, and you can start to do DAGs and causal DAG models. Do you do that at all?
Yeah, so we've been doing different types of like partial correlation networks or Granger causality networks. In Gradient causality, we get, or just we can also overlay Gradient causality on these ones and putting arrows in places where we find some causality. But we haven't gotten too far with them because they need a lot of research and actually the back testing and okay, so what is the information actually I get out of this? So it's relatively easy to do those, but understanding and using them is more difficult. People like quite often they understand correlations and they know how to use correlations, so then this fits sort of into their existing world better.
But just a very quick point, if the inverse correlation matrix, if there's a heavy Markovian structure, it tends to be very sparse.
Yeah.
So in other fields like spatial things, they used it, you can speed up your algorithms sort of quicker with the inverse because there's all the Markov structure will give you lots and lots of zeros.
Okay. Okay.
Okay, we'll have a quick question from the back and
I don't know if it's the same as the last question. So I don't know if you're familiar with graphical models.
That's the same.
Yeah.
So basically these graphs are in a sense graphs in graphical model sets
Yeah.
where nodes are random variables and edges are
Yeah.
some sort of dependencies or correlations. And you can make different types of graphical models. For example, as Henry said, if you work on partial correlations, you get a completely different result. But there's a lot of theory behind that, so you can use that theory in order to statistically model these graphs, really.
in the interest of staying on time, sorry, if you are, let's thank Kimmo again.